in the aftermath of what we saw last Friday with Silicon Valley Bank, Signature Bank, and seemingly today with Credit Suisse. So we will get into all sorts of fun things in 1 minute time. So hold tight, we'll have some fun. Good afternoon. This is Bob Stark from Kyriba, and welcome to our webinar. Not always the funnest thing to talk about. A warning of financial resilience kicked off and precipitated by the events last week. For those that are watching live, for those that are on demand, I'll say Friday, March 10th. So a lot of things have happened in the past few days, and well, hopefully all of that is contained to what we saw start and end at the end of last week. The reality is there's even news out today. We're recording this on Wednesday, March 15th. And there's news about Credit Suisse in Europe and potential contagion that drives from that. So it would appear that there's possibility that this news cycle continues on the health of financial institutions and obviously the impacts on corporate CFOs and treasurers like yourself in terms of wondering, what is it that I need to know? What is it that I need to do? What are the best opportunities to be as resilient as possible to potential impacts on our cash, liquidity, and financial operations? So with that, let's introduce the panel. I have my friends and colleagues on board to chat about what we're seeing, what we're hearing from our clients, and different opportunities that we think are relevant and interesting for all of you to know. So I'm going to go from left to right. Greg Person, Tom Gavigan, and Dory Maloof. Greg, if you want to introduce yourself first, followed by Tom and Dory, then we can kick in and have some fun and Q&A with ourselves. So Greg.
Yeah, certainly. Yeah, thank you, Bob, and good to see my friends on the call here this afternoon. My name is Greg Person. I'm the Senior Vice President here at Kyriba. Been with the firm for 9 years. I currently look after our North American account management, sales, and our partner strategy here for the firm. Been in a variety of roles over the years, both domestically and overseas. But prior, I spent majority of my career in corporate treasury. I was in different roles here in the Metro Boston area with a large medical device company and a data storage company for that. And yeah, very pleased to be here today to speak to you, Bob, and the colleagues around some of these events that have unfolded here the last several days and how it's impacted some of our clients and how we're looking at solutions to support them. So pleased to be with you.
Thank you, Greg. Tom?
Yeah, thanks, Bob. Hey, everybody. My name's Tom Gavigan. I lead our global pre-sales team at Kyriba. I've been here for 9 years as well, and I've worked alongside these gentlemen for those 9 years, and pleased to be on a session with them today, albeit I wish it was under better circumstances, I guess, but work very closely with our prospective customers as well as very closely with our existing customers, and recently over the past 48 hours, I would say, actively engaged in discussing how platforms and technology help CFOs, treasurers get a hold of or get ahead of the situation we're in. So looking forward to chatting more with you, with all three of you here today.
Thank you, Tom. Dory.
Nice to be with everybody. Very humbled to be on this panel, by the way. These are like the brain trust of Kyriba on this webinar today. But I'm Dory Maloof. I've been part of the Kyriba organization for the past 6 years. I come from the practicing background like Greg, and I lead our North America Value Engineering team. We work directly with prospective clients, already established clients, to really map out their success story and how to best leverage our platform and get the most value out of it.
Excellent, Dory. Thank you for that. So the interesting part of this panel, Greg, Tom, and Dory and I have worked together for a long time, and generally we were talking quite often over the past few days and realized we should probably just elevate this conversation to a webinar, because I think there's a lot of people that would be appreciative to be part of this conversation and join us. And obviously through Q&A, feel free to ask and we'll answer anything that you want to hear. We'll be as transparent as we possibly can. I think there's a tremendous amount of interest in what does this mean for us as corporate practitioners in finance, treasury, and CFOs. There's a variety of actually people that are attending this live, never mind consuming this on demand afterwards. So let's kind of just start with the fun chats, folks. So what was most surprising to you? Dory, I'm going to start with you. I have some interesting things to add as well, but I want to hear your perspectives first of everything. And I know I'm making you choose from a long list, Dory, but what surprised you the most?
Yeah, thank you, Bob. But what surprises me the most is that we were all surprised, myself included in that category. When you have pretty much free money since really 2008, since back in the real estate crisis, and all of a sudden you slam the brakes on that over the past 6 months or so with what the Fed doing, things are going to break, accidents are going to happen. And that's really where we are today. And none of us should be surprised. What we should be looking at is what is the contagion effect? Because certainly these few banks that you mentioned in the intro, Bob, are not the only ones. There will be others potentially. And the contagion effect is going to be on corporate America, the high growth companies trying to look for capital and not being able to get the capital at favorable interest rates at all, and if they even get it. So it could lead to potential bankruptcies. Who knows where we're headed? But I think what I'm surprised by is that we were all surprised and we should not have been.
That's a very fair statement. And certainly the surprise part, it's easy to decompose it. You just think, okay, well, interest rates rose really rapidly and there's a disconnect between monetary policy and bank regulatory policy. And some banks, I mean, we'll just say SVB would seem to be one of those examples where they were just unprepared for rapidly rising interest rates and that disparity. They just didn't have a profit margin that supported ongoing resilience to this interest rate environment. And I'm sure the next interest rate shock, which was scheduled, to come out very soon, probably maybe doesn't happen. But as a result, that would have hurt them even more. And that precarious position wasn't going to get better at all. There was no good end in sight to that. So excellent point, Dory. I mean, Tom, Greg, what was surprising to you?
Yeah, I think what's surprising to me is perhaps troubling at least, is that as Silicon Valley was a single A rated bank, a few days ago, and I think back to my days in Treasury and our investment policy and what got approved by our audit committee and everything, you kind of, certainly had a certain trust or comfort in a single A name. And to see this sort of play out this so quickly, I think is surprising. I think, I was speaking to some clients here even this week and really getting now into, how do you regain that confidence? It's well publicized. Obviously, they had an issue with their held maturity securities. The carrying value of that, the fair value of that was about $15 billion less than was on the balance sheet. So I think that kind of exposure, and to Dory's point as well, I mean, it is surprising. Is it something we should be shocked about, or is it something we should be taking a bit more due diligence as a investment compliance and looking at our underlying holdings a bit more scrutiny? I think we're seeing that. I know we're seeing that. We're talking to clients, real time. They're getting in the footnotes now of some of these banks, so especially the regional banks, and making sure that there's an understanding around that. But I think to answer the question directly, I think what is probably most surprising is, they were single A rated, and now here we are. So it's kind of a rude awakening, isn't it?
It's a good word, rude awakening. Absolutely. Mr. Gavigan.
I won't reiterate everything that the team said here. I think obviously there's always going to be macroeconomic things occurring that are going to strain our banking structure. In order for these things to occur, there's multiple things that have to go wrong. And as Greg pointed out, you have misaligned credit ratings, as well as the softening of regulations that open up opportunity here. What I'm surprised by, I'll talk about the aftermath or what we're living in now. I'm surprised and pleased with the government response to this in terms of, not necessarily adhering to the FDIC limit, so that's certainly helping things as it relates to consumers, I would say, and the customers of Silicon Valley. But also what I would say is just how some organizations or companies have overextended or over exposed and impacting their overall liquidity here, not having perhaps the controls in place in order to get ahead of that. But there's articles and things out there that you read about large organizations that had a significant amount of cash sitting with that bank. And with today's banking the way banks work and the way that technologies are available, ensuring that you're distributed in a way so that you're not overextended or overexposed with a certain bank or within a certain region, that's certainly avoidable, right? And I guess that's why we're here today.
Yeah, it certainly is. Those are great observations. Here's one additional item. In terms of what was surprising to me, it's actually a very positive thing, my answer, and a bit more operational and tactical. I expected the moment that this news started to basically go viral, for lack of a better term, on Friday morning, that there was no interruption, at least from our clients anyway, access, like for those that actually had accounts at SVB or even had payments run out of SVB, which you have some clients that do. None of them had challenges. Like they were still able to get their balances and transactions. They were still able to send payments. So I'm not saying that it was like nothing happened, because that clearly wasn't the case. There was a whole stream of activity and chaos and concern for a variety of reasons. But it wasn't that I don't have visibility. That suddenly the systems turned off. Like none of those things happened. And so I thought that was very positive, because I would think, I was in a webinar with another client this morning talking about real-time payments, real-time treasury, real-time liquidity and whatnot, all the API capabilities they have through our platform. And they made the point that they couldn't imagine flying blind in a scenario like that, where they didn't have instant visibility into their cash and they didn't have the ability to initiate and draw payments. Whether you're extracting cash because you're a little concerned about whether that's going to be there at the end of the day, or whether you're in a scenario where you're just trying to routinely disperse funds, pay suppliers, etc. But the fact that it was uninterrupted, I kind of expected that the bank would be maybe cutting some of those things off or stopping the run, so to speak, and it just didn't happen. So I thought that was a bit interesting, and again, warming compared to some of the bad news that was out there that day.
I think, Bob, to your point on the real-time payments, and to Tom's point on the FDIC insurance, I think both of those kind of converge together. The social media aspect of it, where it created this fear factor, there was a mini flight to safety because of the social media effect, and you could do that with a click of a button on your phone now. And then probably part of the reason why they had to put that FDIC no limit protection on your deposits to minimize that. But if you had, as a consumer or as a corporate entity, funds in any regional bank that you were concerned about, you started to get concerned and you started to worry, where do I need to put that just in case, as a protection mechanism? So that FDIC certainly helped, and I think the social media fear factor effect was a little bit surprising, but one of those that we should not have been surprised by as well.
Yeah, in reflection, there is no surprise that SVB went viral. It makes perfect sense. The phone kind of caused it. The phone gives us access to everything, and those on the consumer side, like, I need to get my money out. And obviously that just builds upon itself, like everything in social media these days. So yeah, it's a fair observation, but I agree that part isn't as surprising. All right, let's kind of flip to present day and think about, well, what now? Because Friday was Friday, everyone was saved, all those things are good. I guess there's maybe some, we'll call it storm clouds on the horizon, just because that news cycle, at least in related to other banks globally, hasn't completely gone away. So let's just say there's some uncertainty remaining. Let's talk about business continuity though, because that's the first thing that comes to mind when you think of, is my bank going to go away? Is what happens? And a lot of organizations do a really good job of planning to ensure that what if I don't have access to my cash? What happens if I don't have access to that funding? What happens if I don't have access to the payments? Most people aren't anticipating my bank goes away, which didn't happen, but some people were concerned that that was a possibility. But it's more what happens if I have a freeze for a period of time? What happens if there's another bank that, whether it's US or internationally, that suddenly is not available for a period of time? Do CFOs and treasurers have the business continuity in place? So what do you all think? Like what are the kind of questions you're asking, and what are we seeing in terms of questions and answers here?
I can start on that one, guys, if I may. I mean, and perhaps I'll start with some commentary to the first question, and just to piggyback on some other comments. I think it's fair to say that what happened on Friday and down to the question about what we do about it, it's not new. You know, I think if you've been in the space for a while, as in Treasury a long time, you know, days like Friday happen. We've all lived through them. I can think back to the, you know, when the Argentine peso lost, you know, massive value in a certain day, or the Russian ruble had to devalue in a certain day. You know, getting that call from my CFO saying, you know, Greg, what's our exposure to the Argentine peso or the Russian ruble bank name? So it was a wake up call, I would say, on Friday, that these things happen, right? And in Treasury, these are, you know, we do our job well, and we don't get a whole lot of attention some days, or like a sort of a steady deliverable around how we manage, you know, risk and liquidity. But it's days like Friday that really, you know, try us. And I think it's a wake up call if you haven't lived through that, or you haven't been through a day where, you know, you know, it's a real sort of dramatic panic around, gosh, you know, do I see my cash? Can I mobilize my cash? If you haven't lived through that, you lived through it on Friday, I think it's a good experience. And for those who've been through it before, it's a good wake up call for us all. And coming back to the, you know, the contingency or the planning, and to piggyback on what Tom's story or Bob were saying, it's confidence, and confidence happens with insight to data, right? So being able to answer that question on demand, you know, what is my exposure? What is my risk? Being able to get to that, you know, that answer quickly and confidently. I think, you know, again, coming out of many years in finance and treasury, it's delivering an answer with confidence, right? Not wanting to rush an answer to my CFO or my board or my audit committee to answer because I have to answer, but answering that with conviction and confidence that you understand what that exposure is, and then what we're going to do about it. So I think, you know, I think speaking on behalf of hopefully all of us, we're very proud of how we've handled that for our clients here the last several days. But I think it's important to realize that as unpleasant as Friday is and the aftermath, you know, these are things, that's why we're in this profession. And it's, you know, it's a good test and wake-up call for all of us.
Yeah, the one thing that comes to my mind when I look at this on the slide is we always preach one of the biggest values when we're working with prospective clients or already established clients looking to do, for example, payment networks within our platform on the value engineering team. We always talk about being bank agnostic and not having to rely on your internal resources or anything like that to flip the switch and be active with a bank and executing what you need to execute on in the event that things do get frozen or tied up for any reason. It didn't happen in this case. It doesn't say that it's not going to happen in the future. But if it were to, that's the value that we preach all the time of having a solution that is bank agnostic and being able to flip the switch and execute transactions with a bank that is live, just to get payments out the door or payroll or whatever the scenario. I think that that's a key point that drives the risk from a treasurer's mindset and what we do to mitigate that risk.
And I just think it puts a heightened focus on our disciplines, right? To Greg's point, I think from a personal and from a professional perspective, we all follow certain disciplines and adhere to certain processes and things, and sometimes you stray away from it. And I think that Friday's a wake-up call to Greg's point, whether it's a bank issue, whether it's a currency movement, whether it's a country or geopolitical issue, any of those situations force us to take a quick view, right, and answer those questions immediately. To Greg's point, you know, the CFO asking about what's the exposure to a certain currency or where certain location. Everybody did that on Friday. It's how quickly you can respond to it. I know personally, I took a look at things myself, right, in terms of where my financial picture was, just to kind of get that confidence, I guess, back when it's shaken in a situation like Friday. And corporations are doing that in millions of multipliers as it relates to some organizations sitting there with 20 billions of dollars sitting in that bank, right, or large percents of that liquidity sitting in that bank. And how quickly can you get there, right? So people should be asking, how long did it take you to answer that question on Friday? And what's good and what's bad, I guess, and what's your measure of effectiveness there? But I do believe it everybody took a look in the mirror and our professional lives on Friday and to see what do we have in our disposal to help us answer, address those questions and be dynamic when we need to make action on those things.
Yeah, it's a really good point. I like that, taking stock of where you are and just making sure that you understand what your exposure is. It's a great point, Tom, and Dory made it earlier as well. I've talked to quite a few organizations that they were happy with the way it worked out, because obviously it could have been more disastrous, but they're also reconsidering the banking structure that they have. And not so much here in the States, because most organizations have, I don't want to say backups per se, but they have multiple relationships. It's pretty normal for Treasury. And some have many relationships, some just have a handful domestically. That wasn't necessarily the concern, because you have an ability through a variety of tools, wires, ACH, even RTP domestically, you can move money relatively easily. The challenge is that a lot of banking structures have maybe a single relationship in some of the countries where you have smaller books of business. And so as a result, you have more of a liquidity challenge if that particular institution in that country has a problem. And that could be if you have localized relationships. So I've heard from a few that were asking questions about maybe we should rethink the footprint that we have so that we are resilient to whatever happens, whether it's a country issue, whether it's a bank in a country issue, which maybe wasn't as factored into those plans before.
Yeah,
I think, yeah, just I would just go on a bit further and say, is obviously we see as a better practice or best practice, arguably, is it is a disciplined investment strategy and consolidation strategy. So that the clients aren't holding operational cash balances in the millions, let alone tens of millions in operational accounts, not just for the counterparty risk, obviously, but especially with rising rates and yield opportunities, that cash should be better deployed elsewhere through various investment vehicles. So I think what we'll see, and for those that are already there, is that through a cash consolidation practice, through a that kind of mantra of having the right liquidity at the right account with the right level of risk and control, right? Making sure that is deployed the right way, and then from the excess cash, maybe looking at the investment policy with a bit more scrutiny. Again, speaking to a client this week, and they're going through this particular client has a business requirement of having various local, regional accounts with branches, to support their business model and how they do business. So going into their footnotes and disclosures and doing that same ratio of, what is true cash or available for sale, the maturity, and how does the balance sheet of the footnote actually disclose that, and are they also exposed with that the fair value risk for the Silicon Valley? To be a little bit more perhaps scrutiny around that, but I don't think I think there should be a better practice of really challenging why are we holding large operational bank balances at a local account. And then from an investment perspective, we do our clients do a lot of great work with the likes of ICD and other money market portals that give you that transparency, so you understand what that underlying holding is. So I think you'll hopefully see a resurgence in that discipline and focus around mobilizing that cash into really prudent investment vehicles. And I think also we work with other kind of progressive partners. GECO comes to mind. GECO is a firm that really focuses on just owning treasuries, like directly owning treasuries, without the burden of going through a broker dealer. So those kind of opportunities might be more appropriate now to make sure there's the right diversification around counterparty risk. Going back to an opening point, a single A rated name, and that now you're in this situation. So I think that will get hopefully a little bit more focus in the months ahead.
Yeah, and I want to continue this point in the next question, because I think there's way to build on this. To your point, what you were saying a moment ago, Greg, is when we talk about liquidity planning, we need to talk in terms of real time. There is no doubt about this. Webinar I presented earlier, even today, we focus completely on real time, real time, real time. Everything needs to be real time. This exercise shows that having, we'll say, embargoed visibility into your data is not good enough, because it doesn't drive the immediacy of the decisions that need to be made right now on demand. And I think this showcased, if nothing else, that if you only had visibility once a day into your balances at SVB, you probably would have been a lot more concerned than having more updated and real-time visibility. So that's part of it. But the exercise I look at, and Tom and Dory, I'll point to you and Greg as well, is that I look at this as a need to extend the cash forecast and make it a bit more actionable in terms of what is my strategy to manage liquidity across the organization. This is not just a where's my cash balance, like what's my bank balance look like, is it okay? It's how am I, depending on what scenarios happen, and maybe some people didn't build in this scenario of I might not have availability of my bank. I might not have access to those funds for some period of time. So maybe that scenario wasn't built in, but maybe other scenarios were built into your forecasting. I think it's really important to ensure that you're able to answer that question. Yes, what is our exposure right now? But what is our plan should we have to make different decisions? What happens if, say, the dollar dropped to $1.50 with basically just over a day of trading, starting last Friday into Monday? That's a big hit, and that can really affect, that kind of volatility can really mess up with your balance sheet, income statement, and cash flow values. Same on the interest rate side, those kind of shocks, whether you're expecting one or not expecting one, or inflation scenarios, or your bank goes away for some period of time scenario. Your liquidity planning should incorporate all of these, so you can say, if this happens, then here's what we need to do, and have those plans in place so that you're not reacting in the moment. You're simply executing a series of steps that you'd already planned out in case this or in case that. What do you think?
I think the word that comes to mind is confidence, and I think that was what was shaken. And I think what we're hearing and what we're talking about is gaining that confidence. I think first, as you point out, liquidity is more than cash, right? And that's an important part. I was reading an article on New York Times about some of the SVB customers, and one customer that they had highlighted that a quarter of their cash was sitting there, but they commented that they have $135 million of investments outside of that bank that they're going to use in order to manage the liquidity, right? They were able to answer that question, right, about what they have now and also what they're expecting to occur. I would say that's confidence, right? Now, it was shaken, but it was confident. But I think it's important that we look at, companies look at the source of all that liquidity and the types of the liquidity that they have, and making sure that it's consolidated, and then also providing that short-term and long-term planning that goes into gaining that confidence. Because to Greg's point, and what I shared earlier about that SVB customer, is they're confident and they know where their investments are, such that they can liquidate and fund what they might need to fund. But without technology, right, without a system or processes in place, that's a lot of chasing around that needs to occur before you can even make a decision on that. So I think it's a matter of identifying the sources of the liquidity and centralizing all of that. Time horizons are going to be subjective depending upon the company, the organization, the market that they're in. But the word that comes to mind for me is confidence.
I think it's that, and I completely agree with Tom, but I also think it's that single source of truth, that ecosystem that gives you the full line of sight on your entire liquidity picture, including working capital. Maybe a couple of weeks ago, actually, I was talking to one CFO, actually a CFO I used to work with, and they had a receivables financing program, and they were considering shutting that down because interest rates were so high, and it was impacting the revenue when you put that type of a program in place, because you take a discount on that receivable. Now they're reconsidering that because they want certainty on that receivable that it's going to get paid. And as interest rates continue to rise, or who knows what the Fed is going to do next week or not, working capital is going to be a key player in financing the organization, whether it's on the receivable side or the payable side. And even on the receivable side is going to continue to be valuable for an organization to put in place or continue to keep the program running because they want certainty that cash is going to come in the door. And they don't want to have to go chasing it because there will be a contagion effect where some businesses are impacted. And the last thing you want is to not go to your CFO with certainty on what's coming in the door to be able to control what's going out the door. And I think that's the key, is that full liquidity picture and liquidity planning, tying into it the working capital, and make sure that you have that line of sight of safeguarding the company's assets.
Yeah, I'm going to add the word actionable to what you just said, Dory, because I think, like, we all know it because we talk about it all the time, but just for the benefit of everyone listening, it's the visibility is important. And I think you heard that loud and clear from what we just talked about. But it's also that actionability. Like, to your point, Dory, if you're in a situation, like whatever is happening, you have cash flow targets the organization needs to meet. You don't want to have to be going back to the CFO to say, yeah, we're not going to meet those cash flow targets because of something that, whether it was or wasn't in your control, it could have been in your control because you could have had the levers like DPO and DSO to play with to be able to make changes to the amount of free cash flow you're generating. And it's that connection between the visibility and the what am I going to do about it that you really need the data strategy and your platform to support that. I mean, that's why we have things like APIs. That's why we have AI. That's why we have automation and analytics, so that we can do all those things. We don't have to use 8 different systems and back of envelopes and spreadsheets to make that happen. So I'd like to word that, like, that word actionability is one that I'm using a lot more often these days, because it shows that there's some connective tissue between your visibility and what you're going to do with that visibility. All right, any other comments on this one before we move to a very fun topic next? I think I dangled that as extra fun, so now I have to go to it. Let's talk about reducing vulnerability to rising rates and volatility and FX volatility. The reason I put this one on here, I think we can all appreciate that organizations, especially last year, you look at American organizations, but now we've seen the similar effect in other regions at different times, different intervals, which as rates rose in the US, but maybe not somewhere else, then we suddenly saw a lot more chop and volatility and roller coaster effect in currency markets. But in the end, that term, reducing vulnerability to rising rates, is something that we have been working with CFOs and treasurers to understand, quantify that impact, and be able to either explain it and or take action to mitigate it. That seems like there was a lesson that SVB kind of missed, that most banks really do understand. This is not a commentary on that, but let's flip it to the corporate side. Given that there's continued volatility in both of these indicators, I mean, inflation is not reacting in the way that many organizations and governments would like to see. As a result, there's some expectation, even if it's not next week, that there's probably still interest rate movement to come. Certainly FX volatility, that's been all over the place just in the past few days, never mind past weeks, months, year, all of that. Is there an opportunity? Is this a conversation that should be happening again, just to reinforce the need that you need to ensure that you have mitigated that vulnerability, that you can do everything you can to reduce the operating costs that go along with unnecessary borrowing, or protect your balance sheets, income statements, and cash flow from FX that you should be able to make go away?
Yeah, I'm happy to start here. I think it's well, I think it is getting more scrutiny, right? I read earnings calls and things every quarter, and when borrowing was cheap, it's a little bit less on the commentary on a call, or getting any scrutiny perhaps from the board or from the street as far as some of that discipline. I just think it is, right? It is certainly more scrutinized, what's the financing cost, what's going through the P&L from interest expense perspective. So just naturally in a rising rate environment, again, for a lot of us that were here, going back well before the low, there was probably a bit more of a focus in our role, right, and how we look at borrowing costs, that we had maybe different scrutiny around that. But I think it's just a wake-up call, right? It's getting back to a normal practice of looking at interest rate risk in a more, again, holistic and responsible way than maybe we haven't in the last several years with low rates. I think your point too, Bob, as far as the, just that the actionable data, right, and whether or not you do something about it, but again, not to speak too much about our platform, but our clients are able to model, we have a floating rate debt instrument or credit facility utilization, workflows and things and scenarios that you can run, to see what interest expense will be, whether that impacts the overall cash flow and the P&L, how it's going to flow through the various costs in the organization ultimately from an earnings perspective. Those tools are probably more healthy to run through now that it's cost of borrowing is more expensive, and making sure you have a tighter forecast and a tighter financial plan around that is prudent. So I do think that actionable data, whether or not you make a decision against it, whether or not you make a decision to swap out floating rate debt with an interest rate swap or any sort of interim behind it, those are ultimately decisions that based off of risk and perspective that our treasurers and CFOs will make. But I think where we can give, to Tom's point earlier too, confidence in that decision making, through different models, different tools, and different model things. It should be get a bit more scrutiny, given that where the rates are and where rates are moving towards. So I think that that vulnerability is a term here in the slide. Yeah, I think there's more vulnerabilities in there, right, with the rising rates. FX, we saw a very unusual summer last year with a strong dollar, and I think a lot of clients and a lot of treasurers had to get smart quickly around that, and hopefully make the right decisions around cost of hedging and whatnot. But again, it comes down to that the transparency of the data, the understanding, and the confidence ultimately that makes some recommendations as treasury professionals.
And I'll echo what Greg said and add to it that it's that piece of knowing what's going to happen. You're not going to be able to control it. You're only going to be able to manage it. And you want to manage it in as quickly of a time and as confidently as possible. And that's the key in this scenario, whether it's tied to interest rates or foreign currency. Those are things that are not really controlled by you. They're controlled by the market and whatever the news of the day is. What you want to be able to do is be able to inform and manage that activity reliably and timely to mitigate the risk for your organization. And that's the key, right? That's why we talk about financial resilience in times of uncertainty, because when you have this level of uncertainty that is out of your control, you want to be certain in what you message to your management team. And that's what helps you as an individual in your career to gain the trust of the board and gain the trust of your CFO, but also it helps the organization in turn to be at a competitive advantage compared to its peers and be able to manage this uncertainty more reliably and more timely to those that have the capacity to do that.
Big one up before you go. Sorry, Tom. It's just, we talk about in the slide here, interest rates and FX. It's counterparty too, I would have thought. I mean, I think there's going to be a lot of, it has been like a lot of questions here the last several days about, do we have the right investment policy? Do we need to tweak that? Do we look at overall investable balances and have, different ratios and how we calculate, prudent counterparty risk? But I think for sure that, financial resilience is also, resilience around counterparty risk for sure. I'm sure a lot of conversations are being held now, and obviously data and reporting and again, scenario analysis to help to model that in a prudent way is something I suspect we'll see a lot more of.
And that was where I was just going to go to tie this out. I think, Friday was a bank thing, right? Over the summer, as Greg mentioned, it was currency related to dollar. This time last year, it was Eastern European, sovereign issues that companies were looking at. 3 years ago, this time 3 years ago, it was COVID, right? And there's a lot of once in a lifetime events occurring all at once, in my opinion. but it heightens that focus, I guess, on being prepared, being resilient, and being confident in what you're trying to do. I think as it relates to the interest rate and FX component, it's about the focus is on gaining information, having access to the information such that you know what is vulnerable and what's at risk, so that you can protect it through your various hedging strategies. And I think also, what we see now in the aftermath of Friday, similar to, in my opinion, kind of like that, when we look back at the start of COVID and isolation and all that, was the liquidity strain and enforcing or ensuring that we're maintaining our cash and maintaining the cash flow, maintaining the cash conversion cycle at all costs, and having the actionability behind it. Even though interest rates are going to impact that, but being able to solidify receivables and bring that cash in, as well as manage your payables on the outstanding. These are other alternatives and actions that customers can do with their cash in order to navigate what right now is a very volatile interest rate environment.
Yeah, that cash flow conversion cycle is going to be very, very key right now. And the other piece that I want to point out is literally right before jumping on this conversation today in a webinar, working with a prospective client, he mentioned to me on the phone that the board is asking him to put together a bank scorecard and what the exposure is for the company from a counterparty risk perspective. He wanted to know if I had an example of how to put one together. We talked through it and I was able to help them, but we want to make sure that not only you want to manage counterparty risk, but you want to manage the potential impact, the reputational impact, if you're caught in a situation that the board doesn't really is fond of at all. So it's that reputational risk that you're trying to protect when you look at the counterparty risk, and that's kind of what caused the contagion effect of the run on SVB Bank as well as others in terms of liquidity, because people just like you and I are trying to protect their assets, and it's better to do that proactively than reactively. And that's kind of like what this gentleman was doing that I was speaking with, is just being reactive. He didn't know how to get to the information. He didn't know how to get to the data and how to get the insights that he needed to put a good report together of what is our exposure, where are our balances, and what are the banking institutions, how viable or how sustainable are they that we're partners with. That's key in this environment.
I think some of it, is just good old fashioned, financial statement review, unfortunately, right? That's my opening comment is, gosh, how was this bank single A rated and then this happens? And I think to your point there, Dory, is some of this is going into the financial statement notes, right? And if we look back at Silicon Valley, they had 173 billion in deposit liabilities, but only 40 billion of cash and available for sale securities as of 12/31. Now, obviously, they had the held to maturity, and that was the whole problem, right? The fair value of those held to maturity position, because rising rates obviously caused that situation. But going through their statements, which everyone can do, right? You can see that that change from 21 to 22, based on that held to maturity. So I think there'll be a lot of discussions. I know it's already happening around the accounting treatments around that, right, and how that should be disclosed. Taking the fair value and how maybe that gets scrutinized a little bit differently. So clients of banks, right, have a bit more understanding of that risk, right? Obviously, banks should have a strong ALM process and all that, and there's lots of publications the last several days of banks that do that extremely well, and there are, of course, many banks that do that extremely well. But it's the right time, as I keep saying, it's a wake-up call, right? And making sure that there is a bit more, due diligence perhaps with some of the regional banks and ensuring that you have that confidence. And then again, a healthy diversification of the excess cash through a prudent investment policy, again, is a good remedy to this.
And if you're not as well versed in financial statements, do a lot of reading. For example, Credit Suisse, they've been in the news for many, many months right now. You're still doing business with them. I'm not sure why. But regardless, do a lot of reading. Get the fundamentals of your bank relationships and what are they in the news for. And that will help you figure out where to put your eggs in, what basket.
to Greg's point, I mean, the SVB, there was articles and analysis out at the end of last year about this, talking about this, right? I remember seeing one on, I think on like Seeking Alpha. So it's not all sudden, right? It's a matter of being ahead of it, being informed, and placing that scrutiny. Greg, I go back, it's discipline, right? And being diligent with your policies and your processes, right? And really focusing on who you're doing business with, I guess, because it's systemic. It's not just one thing, right? It's a number of things that contribute to these types of issues, but the rating was out there as it relates to the issue with that thing.
Yeah, and I think there's an interesting point, because if you look at just this most simplistic, counterparty exposure reporting, Greg, you touched on this a little bit earlier, and there's a lot of people asking questions about that, around what is it that I should be doing differently? What sort of report do I have out of my Treasury system to be able to do that? And obviously those reports exist. I mean, our clients were happy to have them, obviously, last week, and as they maybe recompose what their risk profile of banking relationships that they have, they do business with, maybe looking at that a little bit different lens now than they did last week. But in the end, there's a data element that may not be incorporated in those ratings. So you have to think of, what information am I looking at? Do I need to rewrite, Greg, you mentioned this point before, do I need to rewrite my investment policy or my bank exposure policy or any of these procedures around where I'm managing my cash and liquidity? Because you need to be able to, you don't want to just react to these sorts of things. You may decide that I'm going to look at news items and maybe flag that as a reason for concern. And maybe if there's one of our banking partners that is maybe in the news in a variety of ways that makes us a little uncomfortable, maybe that's a reason, like a procedure to trigger that review to determine if this is the kind of relationship we want to have. Maybe that's important, maybe it's not. But these are the sorts of things that you want to have built into your, not just your reporting, but also your process. Again, it's taking that visibility. What banks are we exposed to? What sort of ratings they have, or other data that we look to compose a risk profile of that particular institution, but then tying it to the actionability. So then what? It's no good to have a procedure or limit that is static. It needs to be modernized, needs to be fluid, and it needs to be actionable. So I mean, I think it's what you're all saying, right?
Yeah, I guess a question to like Greg and Dory from my perspective though is how much more can we put stock in the ratings? Because it's the same that they're a constant in these issues that arise, right? And it was in 08 and now it's here again. And what should organizations do? Because if it's me, they're good for referential purposes, but at this point, why do we trust them? Quite frankly.
Yeah, no, I couldn't agree with you more. I think at the time, correct me if I'm wrong, Lehman Brothers was like A-, right, in 2008,
yeah.
Right? So, and the same thing happened. So, yeah, to what Greg said, look at the financials, and to my point earlier, read and watch a lot of financial news networks like CNBC or Bloomberg or whatever, because these CEOs and these analysts that come on the air, they give you some pretty good insights. And those insights, Tom, like you said on Seeking Alpha about SVB, they've been talking about those for quite some time. Same thing with Credit Suisse. It's been going in the news for many months now. So if you're just intellectually, curious, you should be able to find what you need to measure your counterparty risk.
Yeah. There's a question I want to inject into the conversation. There's a few people starting to ask questions, so I think we'll probably flip to responding to some of those. But it's an interesting one because it plays on the point that you're just making. So I'll read it verbatim. Do you have any suggestions to navigate the responses banks are currently providing during this time? And it goes on as an example. Our dedicated bankers have said they're in a good position and they take a conservative approach to their investments. But up to this point, SVB investing in bonds was a good conservative approach. My first comment would be, I'd actually challenge that last part of it. I think it's not so much the investing in bonds, it's the vulnerability to rising rates in terms of the other part of their portfolio. It's not just what they held, although obviously they had some liquidity challenges in terms of being able to liquidate those assets and turn those into something through hedging that was a bit more flexible. And could keep pace with effectively what they had to pay on their deposits, which was a rising set of interest rates. So I'm not sure I agree with the very last part of that it was a good conservative approach. It may have been at the time seemingly okay in a low interest rate environment, but that strategy didn't translate, and banks need to be able to translate. I think Dorian, Tom, and Greg, that's your point about reading and analyzing and understanding financial statements, is that I think we need to make up our own minds as financial professionals as to what is a good conservative approach and what is the level of risk that we're looking to tolerate. The ratings may not give us that full story. And this is not like this conversation in 2023. It's the exact same conversation we had in 2008, 2009. The ratings were a partial, but not a completely relied upon indicator, because the information they were capturing was dated. But anyway, that's my point. What are yours?
I'll come back to it's a good question, right? I think I hopefully started to answer a little bit earlier on. Is it's just old-fashioned financial statement review sometimes, and those that have these corporates on call, people listening in, if you have cash positions of a certain size that warrants a diversified investment policy, or cash being held at multiple banks, I think it's on us as treasury professionals to kind of know a little bit about how to review those banks' financials and understand what is their asset liability management, what are those liquid cash reserves and available for sale securities that are ability to fund their obligations, their loan obligations. And then also what I did talk about too, which again, talking to some clients directly, is kind of understanding as well the concentration of deposits, right? So if there is a run, or if there is having a big withdrawal, having better insight into the concentration of deposits, the concentration of loans, and those obligations, because that obviously can dictate a real liquidity risk should there be a heavy withdrawal, that if that deposit base is concentrated on a healthy sort of balance. But I think it's asking those tough questions of your bank relationship managers, kind of understanding that coverage, doing that research. Obviously, there's disclosures and there's different reporting you can get across the industry. But I'll come back to it kind of a broken record. I think just having a broader, diversified investment policy, maybe looking at treasuries more, looking at government agencies more, making money market funds. If you understand what your holding is, what your real exposure is, and perhaps having less concentrated risk with just bank names. I spent a long time in Treasury. I did the same, I'm sure, investment techniques that many people on the call here are doing, where you have an investable balance, whether it's onshore, offshore. You have a number of banks in your group that are on your credit facility, and you end up diversifying that across time deposits or bank deposits that you stagger from a maturity standpoint. Maybe that is an area that gets revisited, and looking more direct into treasuries or into money market funds with broader diversification. I think those might be areas that you see as a response. But to the bank question, I think understanding that ALM strategy, the coverage, and the concentration of deposits is probably a good starting point.
And I would just echo, I guess, that don't just leave it up to the name and don't just take it at face value. I think probably SVB bankers were saying the same thing to their customers ahead of this, right? And we also have to consider that it's not just the ALM necessarily the strategy of managing the assets and liabilities, but we always have to keep in mind that there's the accounting aspect of this, right? And that's where these problems end up, whether it's 08 or with SVB, right? The way in which they were able to account for activity is ultimately how they were able to prolong or mask, or whatever you want to call that, the ultimate problem that they had. So while they can say that they're managing something one way, the accounting can because of the way it is, it can hide things or kick a can right down the road that'll ultimately come back and bite us all. You just have to do a little bit more. You can't just take things at face value, I guess. That's what I think we're all learning, and you got to do the digging. We're it's a blessing and a curse right now that there's so much information that we can get access to. Use it, right, in situations like this, and because these banks are exposed, they have, we can look at anything as it relates to their financials and accounting treatments, and I know I'll be looking more closely at that here. And I think one of the things is don't relax it either. It seems like '08 happened and then everything gets tightened and then, everybody's really focused on it. But '08 was a long time ago. Maybe things got relaxed, right? And now here we are in 2023. So what's going to happen in 2020, 2033, right? Are we going to be relaxed again and get hit on the side of the head with another issue like this? I hope not. But, there is that human element of just perhaps, taking down our guard that we have to be careful of.
Well, there's also, oh, sorry, Dora. I was going to say, there's also that additional variable of real time that didn't exist at that point in time. Like, yes, there's an argument. I think there's been some deregulation, we'll call it, in the banking sector that's happened, since 2008, 2009, which is unfortunate. Given some of the folks that were lobbying for that tend to be the ones that are in the crosshairs of what's going on in SVB right now. But if you look at that notion of real time, that did not exist in 2009. We didn't have this viral effect on Twitter. We didn't have the ability to use your phone to do every single banking function you needed, including initiate real-time payments and move your liquidity instantly. So those are some of the challenges that, in addition to what we saw before, Tom, I would agree with your point, but in addition, there's this notion of speed, which has to be factored in, and we have to recognize that what may have previously taken days or weeks or even longer to unfold can happen in an hour, or even less than an hour sometimes. So these are some of the interesting challenges that I think.
We're all kind of marching to the same tune, and the key is, I'll add, is trust your gut. I was in a situation in practice after that Putnam fund failed, where I was asked by the CFO to put together a package of, here's where we have our balances in money market funds, and here's the exposure. And we had 4 key targets that if the fund had exposure to those targets, we were going to withdraw our cash from that fund. So we don't want to be in the same situation. We did the same thing when it came to balances. We had $200 million at a certain bank as just simply a balance as a part of a relationship perk, because they gave us some good favorable terms on our syndication. Well, that bank, although wasn't all over the news, we didn't feel too confident, right? We didn't feel too confident because they weren't the big 3, and we wanted to protect our assets. So our gut told us, just, hey, for now, pull it now, and you can put it back later. And it was a very tough conversation to have with our relationship, but we pulled it and put it back once things settled. But those are the types of things that you're going to have to do and think about and trust your gut, because ultimately it's your name and your reputation and the organization's reputation that's on the line in how you manage your counterparty risk. Do the financial analysis, look at the news, but ultimately trust your gut instinct.
Yeah, great points. All right, let me ask another question that came through. This is kind of a fun one. This could be a webinar itself, actually, so ready for it. All right, blockchain versus banks. Will there be a shift in the long run? I'll give you my opinion first. I think they coexist. I've always felt that blockchain's an accessory, not a replacement for banks. That may be a very dated statement 20 years from now, potentially. But I really feel that the technology is part of a banking structure and complements it, and isn't necessarily a complete replacement. I don't see all of it being decentralized finance as a alternative to banks as a long-term proposition. That's just my opinion. But what do you all think?
I don't think it replaces, at least not careers. Hope I never get recorded on that and play back in a few years. But
Except it is recorded, Greg. But that point aside.
No, I mean, it's an interesting question, especially given the topic of the webinar here. But I think it's, we've seen it. There's definitely use cases for it. Your point is spot on, I think, Bob, as far as they coexist. You have, we've seen some use cases with guarantees and, bid bonds and LCs and things where you have that nice sort of chain, be able to confirm your financial contracts. So I think there's definitely use cases and applicability. Trade comp firms, maybe signatory change management, where you have a more transparent but efficient chain of approvals or authentication financial instruments. So I think you might see that, but I don't know it's going to completely replace what we're seeing in the markets more broadly. But yeah, I think there's definitely a role for it longer term.
It's not replacement, it's augmentation like anything. I think my observation, like, you just think about the evolution of what we live in and from a banking perspective, from, going from seashells and rocks to, coins to checks to, wire payments to now real-time payments and things like that. It's an evolution, but it's always kind of additive almost. And then sometimes things fall out of the bottom. But, my observation, we one of the cool things I get to do is work a lot with banks and banking partners, borrowers and stuff. And I observe there is a race right now from a technology perspective that is occurring more so than what I've seen in the past, I would say, in terms of, offering the latest and greatest and being ahead of the technology curve. So that's going to weigh in, I think, as organizations are evaluating their banks, not just about the returns they're getting, like Dory was mentioning about, certain incentivizations and things that can happen, but who's offering me the latest capabilities from a technology perspective that make me secure, such that blockchain can offer and things. I just think we're going to see that evolution, but I don't see it being like this, obviously, A, overnight, or B, being a full replacement of things.
Yeah, it's sort of like the evolution when it comes to crypto, right? Is that what's going to replace the currency and banking system today? Who knows? But I don't think so. I agree that it kind of supplements, right? And it's good a piece to have on the blockchain side. But and Greg, I'm sure would agree, as former Treasury practitioners, being safe as possible is the key, and being as conservative as possible is the key. So those types of things are good supplements, but they're years away from being having the full-fledged confidence of a corporate structure to leverage.
Yeah, I agree. There's more work to do. I'm a big believer in blockchain. Like, I like it, and I like that it's divested and sort of more disassociated from crypto. Not to say that there's not a future in that either, but yeah, there's a lot of coexistence before we see a sea change in terms of the role banking and financial institutions play in our economic landscape. So that's, anyway, takes us to the top of the hour. So I didn't have time for the other questions. For those that asked, we'll definitely share those offline. But I appreciate all the responses, and certainly feel free to engage with us further. If you'd like us to speak more individually about your situation, we can happily do that. So simply just reach out to us or look for us in our next webinar, with their Insight series and demo series continues every week for the rest of the year. You'll be able to engage and listen to our experts and see our products in the demo series of those webinars. So thank you again for joining at the last minute. Thank you for listening online, and certainly thank you for listening on demand for those that consume this afterwards. Have a wonderful day and be safe, not just with your money, but also your organization's liquidity, so that these are sort of tales that we can shrug off and not have to have personally or professionally affect us too much. Thank you all, and be resilient.
Have a good one.
Thanks, gentlemen.